Principles of Accounting, Chapter 2. In Chapter 2, we're going to start talking about costing methods. We're going to talk about job order costing. So job order costing is the most commonly used costing method. The other two main methods are process costing and activity-based costing. The end of this chapter talks a little bit about activity-based costing, but we're going to have an entire chapter on it later. So this chapter and the next couple chapters focus on job costing. Job costing is the most commonly used costing system. So what a costing system is how a company records product costs. Okay? When costing systems are used are when we make things to order, we have unique jobs, and we can maintain cost records for each job, or when we have a lot of different products that are produced each period. The other type of costing that's called process costing is only used when we make identical things using identical methods. So this is for mass production. Process costing is for mass production of identical items, and we only make one thing at a time. So this is why one of the main reasons that we use job order costing. So when we look at job order costing, we have some examples of companies that would use job order costing. So this has three. One is Boeing. Each airplane would be a job, or Bechtel International, which is a large-scale construction company. A lot of construction companies use job order costing. Each construction project would be a single job. Walt Disney Studios, actually all movie studios use job order costing. Each movie would be a single job, and there would be job costing. One of the things that I like to do is, I know it's geeky, but I always like to count the number of accountants that are listed at the end of movies. For example, Thor Ragnarok had 18 accountants listed in the credits for that movie production. So cost accountants do costing for movie production. So other examples of companies that would use jobs is if you've ever taken your car in for an oil change or some kind of service, that's a job. You have direct materials, oil and new filter. If you have anything else done, you might have direct materials for that. You have direct labor from the person that is changing the oil, and then you have overhead costs. How we determine cost flows is we put direct materials and direct labor to jobs. So we charge the exact amount of direct materials and direct labor that each job is using as it incurs that. We add manufacturing overhead using a manufacturing overhead rate. So one of the reasons that we use this blanket rate versus the actual cost is because we don't always know what our actual costs are going to be, and we need something for budgeting and planning. So the term of applying or allocating overhead to jobs. So when we allocate overhead to jobs, we use what I talked about, this rate. This is an example of a job cost sheet, and we're going to go through the job cost process for this item and talk about how we add different materials to it. But this can be a paper sheet, it can be a computerized sheet, it can be a receipt tab, but as we add costs to this job, they are recorded on a job cost sheet. The date completed, the number of units completed, and this is what we use in order to calculate the cost of both the jobs and the units. Sometimes jobs are just one unit, and sometimes it's a batch of multiple units. So the first thing that we have is direct materials. When we talk about moving direct materials from inventory to a work in process, it's called requisitioning direct materials or putting direct materials into production. So we would fill out a materials requisition form requesting materials be moved to a job. So we have here what direct materials we're asking for, the quantity of the direct materials, the cost of the direct materials, and which job they are being assigned to. So now on our job cost sheet, we are using $116 in direct materials on this job. Then we have labor costs. We get labor costs off of employee time cards, or they either computerized time cards or paper time cards. They would get stamped for when they're working. So here we have that this employee, the name cracks me up, I am skilled, has been working on this particular order and spent 8 hours working on this order at a rate of $15 per hour. That then gets recorded on the job cost sheet. So now we have direct materials costs of $116 and direct labor costs of $120. The only cost we're currently missing is manufacturing overhead. With manufacturing overhead, we use an allocation base. We use a predetermined allocation amount that's measured with an allocation base. What we choose as an allocation base is what drives the cost. So if you remember from chapter 1 where they talked about a cost driver and what is driving those costs. Usually direct labor hours is the cost driver in most of these examples. Machine hours becomes the cost driver when our process is very automated. Okay. But why we use an allocation base, why we use a predetermined base, is because those indirect costs that end up in manufacturing overhead are either impossible or difficult to trace to particular jobs or units. And we have a wide variety of things that end up in manufacturing overhead. Okay? So, and many of our manufacturing overhead costs are fixed, even though the output might fluctuate during the period. So we might use more during 1 month than another, but they're still fixed over the accounting period or an entire year. The calculation to determine manufacturing overhead rate is the total overhead cost for the upcoming period divided by the total units in the allocation base, or the cost driver. So what this would be is if our cost driver or allocation base is direct labor hours, then we would have the total overhead divided by our budgeted number of labor hours for the next period. We use estimated information. So we don't know what our actual expenses are going to be for the next year, but we need to budget and we need a way to calculate how much a job is going to cost us so that we can set pricing, so that we know how much our manufacturing costs are done, or our services if we're a service company. So these are the reasons that we use cost estimates throughout the year. Then eventually we have our actual costs versus our estimated costs, and we have to reconcile those amounts. We create the predetermined overhead rate before any period begins. Normally, this rate is determined once per year as part of the budgeting process. So we estimate the total number of the allocation phase. If we're using direct labor hours, then we're going to estimate how many direct labor hours we need for the year. This is actually one of the things we're going to be doing in the budgeting chapter when we calculate how many labor hours we need based on our production estimate. Then we estimate the total manufacturing overhead cost for the upcoming period and the variable, so the fixed and variable totals. We use the following equation to estimate, remember this is our equation of a line, to estimate the total of manufacturing overhead. And then we compute the predetermined overhead rate. So we're going to look at this example. We have a company that computes its plant-wide predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it is estimated that 20,000 direct labor hours are required for our estimated level of production. We've estimated 94,000 of fixed manufacturing overhead costs, and variable manufacturing overhead costs for the year was $2 per direct labor hour. Okay, so it has these actual numbers. We don't need the actual numbers when we're calculating the overhead rate for the year. That's extra information that it is giving you. Okay, so when we're looking at it, we need to think about that variable rate of $2 and the 94,000 in fixed. So we would put that into our line equation here. So we have 94,000 in fixed plus 2,000 or 20,000 times $2, because it's $2 per direct labor hour and 20,000 direct labor hours. So 20,000 times $2 is 40,000 plus 94,000 is $134,000. So our estimated budget for overhead is $134,000. We would divide that by $20,000, and that gives us an overhead rate of $6.70 per direct labor hour for the year. So let's look at that in another example. So this company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. We have estimated total fixed overhead at 200,000 and variable manufacturing cost at $2.75 per direct labor hour. So we take those numbers and we put those into our cost equation, which is also the formula of a line. And we calculate that our total estimated manufacturing overhead costs are $640,000. We divide that $640,000 by our estimated direct labor hours and get a rate, a predetermined overhead rate of $4 per direct labor hour. That $4 per direct labor hour is the amount that we use when we're allocating overhead to jobs. So the next slide has our job sheet. We had 8 hours of direct labor. Our rate is $4 per direct labor hour. So the overhead that gets allocated to this job is $32. When we're calculating the total cost of the job, we're going to add up all of the costs. So the total cost of this job was $268. Then we can calculate the unit cost of the job. You can see up here that the units completed were 2. So we add up, we have total cost of 268. We divide that by 2 and get a unit product cost of $134.